Good afternoon and welcome to the webinar this afternoon. I'd like to thank you all for coming along today to our webinar. It's part of our My Money series, which is going on throughout all of the current month we're in at the moment, November. So there will be a few other ones for you to join at some other time. Our webinar this afternoon is from CMME, our partner for mortgages. They specialise in contractor and freelancer mortgages, remortgages and protection. You can submit questions throughout this afternoon into the comments box. Please put them in there. I know we've already got a few in there already. And a recording of the webinar will be sent out to all attendees 24 hours after the actual webinar. So I'd like to welcome and introduce and hand over to Simon Butler, who is the head of mortgages and protection at CMME. So Simon, it's over to you.
Thank you, Peter. Afternoon, everyone, and welcome to today's session. Hopefully you can see the slides on the screen. I'm just going to briefly introduce myself and then run through today's session. So just on top of what Peter said, just to let you know, I've been with the company now for 9 years. I started with the company as a broker and moved into a management role just over 4 years ago. I've actually been working in the industry for around 17 years, both as a broker and with many major lenders. So I've got a lot of experience over that period. Now, I'm here today to talk through a couple of different areas that might affect your mortgage plans. We're going to particularly focus on the current market, and so essentially what's going on out there that could potentially affect a mortgage application you might be considering at this time. We're going to look at lenders, criteria changes, which are really essential to the changing face of the market in 2020. I'll talk a little bit about the stamp duty holiday, which hopefully most of you are aware of, and how that may impact any plan purchases during this period, and then the state of interest rates as well and how those have been affected. What I'm also going to do is cover off some tips around how to get your mortgage fit, particularly considering that is the title of today's session. So I'll go through some details around how you can prepare yourself to get ready for a mortgage application, what you should be considering and what you should be doing to prepare yourself. And then I'll just go through a couple of brief updates on IR35 in terms of how that potentially could affect the mortgage application for a contractor, and just be, to effectively tell you what you should be aware of and be prepared for. Now, just to let you know, as Peter's mentioned already, I will be taking questions during the session, so you can ask them while we go through. What I will do is come back to answer them towards the end of the session, just so I can get through the information I've got prepared for today. But just let you know as well, I've got a couple of questions already received from a couple of members, which I will cover off. And if there's any questions that I can't answer today, what I will do is take the information from IPSA and actually contact you just to answer those. Alternatively, you can contact us and speak to a consultant at any time if you'd like to start engaging with us around a mortgage. Now, firstly, let's talk about trends in the market and basically areas to be aware of, things you should be considering and noting this year. Now, obviously 2020, it doesn't really bear remarking on. It's been a very unusual situation for everyone. It's changed a lot of plans, the way the market works in terms of mortgages and housing, and it's had, the COVID situation's had a massive impact on the way the markets work. Now, there were a lot of predictions that 2020 would actually be quite a weak market based on the delay in applications proceeding early this year and effectively the amount of interest in the mortgage market earlier this year. However, as the lockdown eased earlier this year, we've actually seen a huge amount of interest in the mortgage market, particularly fueled around a couple of key areas, but some of that has actually stemmed from the back of pent-up demand. The spring period is normally one of the most busy periods for the mortgage market, and it certainly seemed that as soon as we exited the lockdown period, we saw a lot of interest in terms of buyers looking to move and actually start purchasing. Now, some of that as well, particularly, has been fueled with the increase in home working. As many of you, I'm sure, will be aware of, as you're probably doing this yourself, I'm currently working from home, presenting today. Many people who didn't work from home before had a dual role in an office and out of an office have now found themselves working from home. So we've seen a steady increase as well in applications for people who already own property, looking to expand and increase the size of their mortgage borrowing to actually access funds, to either improve their existing home to add additional space, or even to look at moving to gain additional space. So those are areas where we've seen a huge uplift since the lockdown was released. Now, following on from that, and much to everyone's surprise, to be fair, Rishi Sunak, the Chancellor, announced in July that the stamp duty holiday for purchases up to £500,000 on a single property would, but the stamp duty effectively up to that level would be frozen. Now, if you have taken advantage of this up to this point, congratulations, it's a significant saving for most people. But what you may or may not be aware of is that the saving itself is so significant that it's also pushed a huge amount of applications into the market that perhaps wouldn't have been processed until later in the year. Now, with that in mind, what this has actually meant is that the market has become very, very, very busy, and lenders are struggling to cope with the volume of interest, and actually application volumes are so high at the moment that it's caused, I would say, to be fair, positive and negatives to the market to some degree. It's very much great for the market in terms of volume, but it's very testing for the market in terms of the way lenders are geared up to manage the volume applications. One thing we're noticing particularly is, given that a lot of lenders are trying to cope with effectively staffing their units from home in a lot of cases, but also trying to cope with the volume with having staff in-house, it's meant that we have seen significant delays and increases in mortgage processing times. But at present, the average house buyer, just to give you some figures on this, stands to save roughly £2,500 on their house purchase. But when you look at property purchase somewhere in London, for instance, where we see a huge concentration of contractors, or we have at least historically, then the average house price or flat is closer to £650,000. So that takes the stamp duty savings up to a considerable level of roughly £15,000. Now, one thing I would note, and I'm sure many of you are thinking this as well, especially considering the volume of information in the press I've seen around this, many people have actually taken the opportunity to consider moving out of the capital as well. So I'm sure that's something else we're going to be seeing into 2021 in terms of the volume of applications and interest in that side of the market. Now, one thing I would note, which is really, really important with the stamp duty saving, is it's a very significant piece of value for most people in terms of how much money you can save and how much you potentially can hold back, because you're now no longer having to pay the tax on your purchase. One thing you need to bear in mind though, which is really, really key, and this is just one piece of advice I would point out to begin with, we're finding that lenders, particularly this year, have become very, very sensitive around high loan to values for a mortgage. And what I mean by that is, where before lockdown in March, you would have been able to secure a mortgage with anywhere as little as 5% as a deposit, even 10% in many cases. Many of those mortgages have actually been removed from the market because lenders are concerned around risk. We're seeing a lot of conversations that in 2021 we may start to see property values decrease. So the part of the argument being put forward by lenders is that at this stage, to manage that flow, they're actually dropping those options at this stage to try and cover off any checks and balances they may see in property values coming in and reducing next year. So it's something to be aware of in as far as the saving you're making on your stamp duty, you may have to consider using that money to actually increase your deposit. And I would actually argue you would be sensible to do that, because once you get into looking at a 15 to 20% mortgage at this point in time, sorry, I should say an 80 or an 85% mortgage, so with a 15 to 20% deposit, the interest rates are good, but they're certainly not as low as they have been pre-lockdown. So it's just something to think about. Now, it's important to note that now we're in a further lockdown, there's a chance that the government are going to be forced to actually extend the stamp duty holiday. And if you go onto Google right now, type in stamp duty holiday news, you can find many, many stories on there at the moment, pressure from estate agents and groups lobbying for the government to extend the stamp duty holiday. There's no current news coming out from the Chancellor and the government around this. I believe the pressure will increase simply because, for one reason more than any other, the timescales at this point in time have elongated so much for a purchase that there's a risk that some people will miss out. So we're in a situation right now where we may find that with a hard stop on the stamp duty holiday at the end of March 2021, if an application hasn't completed by that stage, there is a risk that some people may be left disappointed. So there are calls from solicitors groups, estate agency firms for the government to consider that, and I believe it is under review, although we haven't got any news at this stage. So it's definitely one to keep an eye on and into the near future. Now, according to the Financial Times advisor in June 2020, there were 746 changes to residential lending criteria in comparison to 390 in the same month in 2019. Now, while that might not seem hugely significant, I think it's important to understand that when you see those kind of numbers double across that length of time, that's a significant indication that the market and lenders are under strain to cope with demand. And it does show that securing a mortgage at this point has become trickier than it usually would be. So in addition, if you bear in mind as well that lenders have reduced the range of available products, particularly at the high end of the LTV range, then there are a lot of pressures on the mortgage market in terms of helping buyers to secure a mortgage and actually getting the funding you require. Another point to be considered as well is, and this is something that comes up on a fairly regular basis when we're talking to clients, and it's very understandable, the Bank of England slashed the Bank of England base rate at several stages during this year. Now, in initial emergency response to the coronavirus pandemic, the base rate was reduced from 0.75 to 0.25, which is already a historic reduction. Now, then they went one further and reduced it to 0.1% later in the year, and it's remained at that level. And I completely understand, and the argument here is, well, if lenders are seeing this happening and the Bank of England have done this, surely it's putting pressure on lenders to consider dropping interest rates even further, to loosen up and to effectively offer more options at a far cheaper rate. But the issue there is that essentially they don't necessarily need to, because if you understand that demand is still as high as it is at this stage, then there's very little need for lenders to do that. And the other challenge they face as well is, if they do begin to start dropping rates even further, then it's only going to increase application levels, even more than we're seeing at the moment. I mean, I spoke to a lender just this morning in relation to business volumes, because that particular lender is, to be quite frank, keeping themselves at the forefront of the market, but is clearly not able to keep up with the level of demand. And I asked them, to some degree, why have you continued to do this? It's fair to see that you're clearly looking for profit margin, but at the same time, you're not set up at this point in time to deal with the volume of applications you've got. And to some degree, the answer back was a balance of that point, that they feel that they've increased their interest rates to try and stem the tide. However, they're clearly keeping themselves within the top 4 to 5 lenders in the market. And what that means is they're still going to receive a similar level of applications that they were before making those changes. So a lot of this really comes down to appetite from lenders. They have businesses to run, they have targets to hit. And to some degree, if the interest is still there, then there's not a lot of pressure on them to drop interest rates even further. So I would bear that in mind when you're looking at interest rates at this point in time. They're still lower than they have been over the last decade. I mean, we've seen some historic interest rates coming to the market over the last few years, but mortgage lenders are not really in a position where they need to drop these too much further. So I would bear that in mind when you're weighing up whether you should move forward with a mortgage at this point in time. I think the need is probably more important to some degree than the interest rate in certain instances. So it's really important to understand that when you're looking for a new product. Now, I mentioned processing times before, and I think this is probably a really interesting one and really important one to bear in mind when you're considering a mortgage application, especially if we take into account the stamp duty holiday. Now, if we go back to, say, March this year before the lockdown, and a client came to us asking roughly, if I put in an offer for a property now, give you all the documents and information you require to proceed with a mortgage application, roughly how long should I expect before I receive a mortgage offer from the lender? And bearing in mind that process effectively means going through the application, supplying the documents, underwriters reviewing the case, and a surveyor coming out and assessing the property for suitability. Now, it's arguable in that situation, if we go back to March, you would have said somewhere in the region of about 1 to 2 weeks would have been reasonable. And that is about right. I mean, we have some lenders still that would have taken anywhere between 2 to 4, but 1 to 2 weeks would have been reasonable. But it's fair to say at the moment that average has actually increased closer to 4 to 5 weeks at this point in time. So it's really, really important to bear in mind, if you are thinking about moving forward to mortgage, you have to expect those kind of timescales. And it's not unheard of to see anywhere as much as 2 months with some of the bigger lenders out there in the market. A really good example at the moment, a lender such as NatWest, very, very busy lender, very, they're putting themselves at the forefront of the market to secure as many applications as possible. But that lender for self-employed applications at the moment, it's fair to say, is probably looking like somewhere around 2 months to process a mortgage application. So if you are looking for the preferential rates in the market, you really have to understand that if you're looking to go after one of those, there is going to be an elongation of timescales. And then the back end process in and around solicitors, in and around the way they have to effectively assess the documents and details for a lender to confirm that your situation is suitable to complete and actually proceed to secure a property, requires a lot of intervention from government-based departments, such as land registry. And we're finding at the moment that process is quite slow as well. So again, I would say, just as a rough idea at this point in time, if you were proceeding with an application today, from the point you proceed with the mortgage application to actually securing a mortgage offer, it's not unexpected to take anywhere between, I would say, as long as 4 to 6 months before you actually get the keys in your hand. It might sound like quite a long period, but I think this should also highlight why people in the industry, such as ourselves, are really, really interested to see what the government do with the stamp duty shut-off date at the end of March 2021, as that could have a significant impact on the housing market. Now, if we have a look at moving on into tips around areas you should look at and things to think about when you're proceeding with a mortgage, bearing in mind what I've just said around preparing yourself and expecting longer than normal waiting times to actually secure a mortgage offer, there's other things as well you should bear in mind to get yourself in a position where you're ready to proceed. And I think a lot of these points I would say are probably quite common questions we receive from clients and applicants, but the details that are really, really important to understand, because if you can get yourself in the best possible position before you proceed with an application, the process is far smoother, far quicker and far slicker than it will be if you're then having to dig around and chase documents and information later on. And if I would just add one note of caution, particularly on this point, if you think right now that timescales are slow for lenders processing mortgage applications, think about how long it's going to take for lenders to react to requests for bank statements, particularly if you need to go into a branch to secure them, or if you need to go to any other department, your employer, anybody at all, to effectively get some documents and information for an application. So I would suggest just bear in mind everything I'm going to explain now and really start to tackle these areas as quickly as you can, because it's really important to do that. Now, to start with, and I would say this is fundamentally always a really, really key point, credit reports are probably one of the biggest issues we come across for any applicant on a mortgage application. Now, when I use the word it's important to have a healthy profile, it's key to understand what that actually means, and it's important not to get too hung up on the score itself, because a lot of people we speak to, and if I didn't work in this industry, I would understand this. The score might appear to be poor for some applicants, and therefore might suggest that you've actually got a credit problem or there's issues. But actually, the score is an indicator of what has been going on in your recent activity. The activity itself on your report is actually the key here. Now, a really good starting point would be to consider, if you are going to proceed with one of the biggest decisions in your life, and therefore the credit check impacting that is quite severe, closing unused store cards, credit, anything that you're not currently using and not planning to use in the near future is certainly a really important thing to consider, because open credit accounts, a lot of people don't actually realize this. If you have a credit card with, I don't know, to give you an example, you've got a credit card you don't use, it's got a £10,000 balance, available balance on there, but not a penny of it's used. Many lenders will still consider that facility as open and will sometimes reduce the level of borrowing you can secure based on the fact you have that. So it's important to understand, if your income isn't sufficient or it's quite tight in terms of securing the mortgage you're looking to secure, I would consider closing down any accounts that you don't really need. Now, it's also important to bear in mind as well that credit reports do take time to update. So when you're looking at a mortgage application, don't be surprised if you have closed down an account, it doesn't reappear as closed on your report for a couple of months. A lot of the time it can take as long as 2 to 3 months to actually update on your report. So again, it's a really, really key point to actually get ahead and deal with that as soon as you can. Undertaking credit searches before you apply for a mortgage, though, is I cannot honestly say clearly enough, this is one that catches a lot of people out. And it's fundamentally important you don't go ahead and secure credit for anything else leading up to a mortgage application. I would even go as far to say don't do credit checks for a couple of months leading up to a mortgage application, because we see many instances where an applicant may apply for a loan, may apply for a car, they may even just be applying for property insurance, and credit checks are quite often completed by the likes of a lot of online web search companies. So it's really key you don't do that, because that can actually really degrade your score and really damage your chances of getting a mortgage. Now, several months before you apply, make sure your bank account is in order as well. That's really, really, really important to bear in mind, because when you're looking at it from an underwriter's perspective, it's important to be able to demonstrate you manage your finances consistently, and you can present a clear understanding for the underwriter that there aren't any issues within your spending habits and the way that you manage your money. So what I would look to do there is, just as a very simplistic view, look at the next 3 months of your personal bank statements, because that's what the majority of mortgage lenders will look at. They very rarely go beyond 3 months. And what you want to try and do is try to keep your spending habits as little as possible. I'm not saying stop spending altogether, because there needs to be a sense of realism here, and you will also get questions if you present a set of bank statements that don't even show food coming out. It might sound a bit daft, but we do see that quite often, and I think it's important to bear in mind a lender will want to understand you're actually at least alive to some degree, and you are eating, keep yourself going. So what I'm referring to more here is just don't spend huge amounts of money. Try to keep yourself out of your overdraft. It's really important to show that you've got an account in balance. Just make sure that you can present to the lender you're as low risk as possible, because they will really, really scrutinize these details at the moment, even more than at any other point I've been working in this industry. We're really seeing a lot of interest around bill payments and account balances. Now, one that might surprise a lot of people is registration to vote. Now, registering to vote is really, really important, because it's actually a really strong touch point for ascertaining identification during a credit check. So when lenders actually ping the information away from their own systems to many of these link systems out there in the market, so you've got the likes of Experian, Equifax, many other credit agencies, they're all collated under a system that the majority of lenders subscribe to, and information will come back from those very quickly to confirm you are who you say you are and any details around your open accounts. But the registration of voting confirms that you are actually living at the address you've given on the application. And it's a really, really vital one for that reason, because it very quickly confirms you are who you say you are, or at least it should do in terms of the way a lender will look at it. So if you haven't registered to vote, I would suggest you do that ASAP. And I think a lot of local councils are actually chasing to confirm people are actually living where they say they're living at this point in time. I had a letter just the other day from my local council asking me again to confirm I am living and residing at my home. So just bear that in mind, because it's really, really important, and especially if you move from one property to another and then apply for a mortgage, make sure you register again at your new home. Now, another great step to preparing yourself, and it might feel like an obvious one, but knowing how much of a deposit you require will really make or break your plans. And what I mean by that is considering what mortgage options are out there depending on what you're planning to do. So if you go back to what I said a moment ago about deposit levels at this point in time, having a 15% deposit as a minimum is probably going to give you the best possible chance of buying a house right now. If you don't have that level of deposit, I would consider waiting or consider alternatives. And there are fortunately still some alternatives out there where you can get support from family. So you can actually provide evidence from a family member, for instance, that they will actually gift you the deposit. It does have to be a gift. It isn't necessarily acceptable if it's a loan, because the lender will start to ask questions about the repayments of that loan. So again, we often remind clients that we'll need to see letters and evidence from a family member to state it is a gift. Or you can look at products such as Barclays Family Springboard Mortgage, or there's an option with Lloyds at the moment called Lend a Hand, which is where they'll allow you to, a family member to, rather than giving you directly the money for the deposit, they put the money into a savings account with one of those lenders. And effectively, it just gives the lender security and confidence that the equity is there if it's required at any stage to be recalled in. Finally, though, get your paperwork ready and be prepared to be asked for a lot of information. I think having been in this job, as I mentioned already, for many, many years, I've seen the level of information that lenders request and require from a mortgage application increase on a regular basis. And particularly this year, it's got to a stage where the level of detail and level of information you're going to be requested to provide is higher than it's ever been. So you'll typically need to provide 3 months personal and business bank statements if you do work through a company. You'll be required to provide an in-date passport or driver's license, or at least some form of photo identification, proof of your earnings, such as contracts, tax overview documents, trading accounts potentially, and then proof of deposit will always be asked for as well. So it's really key to understand that will mean asking family members to provide bank accounts for where the money perhaps is sitting, a letter signed from them to confirm that they are gifting the deposit to you, other areas and documents and bits and pieces such as that. So whenever you speak to a broker or you speak to a professional in the business you're working with, they will let you know that, or they should let you know that relatively quickly. But I would just prepare yourself to be prepared to do that as quickly as you can be, because it will really help you out once you move into progressing a mortgage application. Now, if we move on to IR35, and I know for many people this is going to be quite a key point at this point in time. For many people that are aware of what IR35 will do and change in the way you work and the way things are, it's also potentially going to have an impact on the mortgage market, as you'd expect it would do, because it will impact the way that your income evidence can be supplied and the way you work and what kind of documents and evidence we can supply to lenders. Now, as you all know, the decision was put off in March this year at the point of lockdown to effectively introduce this the change in legislation to the 6th of April 2021. Now, that has meant that there has been a bit of a reprieve in terms of changes. We've actually, we've seen a huge increase again off the back of that delay in terms of contractors proceeding with mortgages. And we have actually seen a lot of contractors actually telling us that it's a great time for them to get involved and proceed with an application, because it means they can still do that under their current terms. I think I would echo that to some degree if you are thinking about looking at a mortgage, because what I don't necessarily think, and I will talk to you in a second about how we can, or how a broker can potentially prevent this from being a problem for you. We have a lot, we are actually, I would say, certainly reminding a lot of people at this point in time, particularly our core client base being contractors, that it's a good time to proceed with a mortgage application to cut out any potential complication that the changes might bring to the market. Now, what we have seen is many lenders querying the impact of this change for contractors when it comes to issuing contracts. And nearly every mortgage application we're submitting at the moment, regardless of the lender we go to, we're seeing a lot more questions around whether the contract is inside or outside IR35. I know from experience that this isn't necessarily always written into a contract, but we do still find lenders are scrutinising this and asking us questions about it. Now, whether you can continue to work via a limited company or instead choose to use an umbrella, the key here is we are able to present your contract and income to support the mortgage being assessed. And what I wanted to do was just talk to you a little bit about that, because I think to some degree this will probably answer a couple of the questions I received before this webinar today, but should hopefully also ease some of your minds around how there are options out there as a contractor still to secure a mortgage that may negate the need to provide what you would consider to be traditional evidence and information. So umbrellas are accepted presently by a smaller number of lenders than limited companies. So what we found is that a lot of lenders have had to get on board with the idea that the private sector is going to follow the public sector in terms of the way that they manage contractors and the way they put contractors forward for roles. But what it's effectively meant as well is there's been quite a large-scale shift towards the use and expectations that perhaps contractors will use an umbrella if they are going to be inside IR35. Now, what that's meant is we as a contractor specialist have spoken to a lot of lenders. I speak to lenders regularly around this conversation around how we can present to them the client's application in the right way to make sure that the income is assessed in the most appropriate manner. And that conversation is ongoing, and we've made a lot of headway with that this year, but I have no doubt it will continue next year. But it's important to understand where, as a contractor, most applications fall down if you don't present an application in the appropriate way. Now, during the process of underwriting, you're going to be asked for evidence of income. Always the case, and I'm sure you'd expect that to be the case. Now, whether you're a limited company user or you have your own limited company to run your income through, or you're using an umbrella, an application will often fail because when the case is presented to a lender, the wrong information is provided at that point. And it's really difficult to retract the initial information you present to a lender I suppose to some degree when the cat's out of the bag. Whenever you presented initially, that is what the lender will work on. It's very rare they'll allow you to row back. Now, if you're using a limited company, PSC, whatever we want to refer to it as, a lender's default position will normally be to review the accounts and tax overview documents. We used to be asked many years ago to provide SA 302s. I know those have been phased out, so the tax overview documents to some degree have replaced those. Now, the problem we've always seen, and this company has been running now and dealing with contractors for over 10 years. The problem we saw in the market when we started to deal with contractors was what it fundamentally ignores is the level of income that most contractors receive. Because essentially, if you start to look at the accounts and the information within the accounts, there's a limitation on what a lender will actually accept. So most lenders will normally default to using salary and dividend drawings. Some will consider looking at salary and net profit, but not all of them will. And I think it's really important to understand that if you are running a company that's effectively it's as tax efficient as it can be, then essentially your salary and your dividends will not be a reasonable reflection of the actual annualized contract rate. So what we tend to do is approach lenders. We put forward the fact that you have a contract. You have a contract in place on a day rate. Let's say your day rate is £400 a day. And what we'll ask the lender to do is annualize the contract rate. And then instead of supplying the accounts, we're actually able to supply business bank statements to support the level of income coming into the business to confirm effectively that if we use the annualized contract rate, essentially they can see the same level of income coming into the business accounts. And the majority of lenders out there in the market that are amenable to dealing with contractors will accept that and will see that as an acceptable proof of income. We often supply CVs as well, because what that allows us to do is confirm to the lender that a contractor has been doing what they do for a living for many, many years, so there should be less concerns about them as a potential applicant. Now, that's limited company, but what we have with an umbrella is a slightly different approach. With umbrellas, you may or may not be aware of this, but when a lender scrutinises the payslips for someone using an umbrella, the way that the income is separated on the payslips is often an issue. So there's usually a large proportion of bonus or commission income listed on the payslips. And what most lenders will tend to do is look at the static salary figure as opposed to incorporating the commission into the figures. So we essentially go for, to some degree, a very similar route with this. We present the personal bank statements to show the income net of any tax being taken off. And we, again, provide the contracts and ask the lender to annualize the daily or hourly rate off the back of that. And again, if we support that with additional contracts if required, we support that with a CV or any other evidence the lender requires to circumnavigate the need to look at the payslips, we can usually then get a lender looking at the full amount of your income. So what it allows you to do is get a much, much bigger level of affordability than you would do if you were looking at just simply your accounts. Now, hopefully that's helped on a few bits and pieces and around how to get mortgage fit and just to initially explain how we can approach this for limited companies, for umbrellas. But what I also wanted to do was just move on to answer a couple of questions that I had already received today. So these came in from a couple of early responders. So first of all, a gentleman called Simon sent me some questions to answer. And I think actually I've been browsing the questions that have just been coming in, just to let you know, if I don't particularly pick out any of your questions in the box that have appeared, I will come back to you personally and answer them for you. So don't worry, I'll do that throughout the day. But I actually think a few of these answers are going to answer a couple of those questions. But if I haven't answered it, I'll still respond to you anyway and just ask if you still wanted some further clarity. By the way, as well, if you do want to speak to a consultant, we have plenty of consultants you can speak to who will be more than happy to answer these. So anyway, on to Simon's questions. So Simon asked, first of all, which sources of income do lenders take into consideration when considering a mortgage application? Is it salary, dividend, or both? Now, as I've mentioned already, if you're a contractor, the process I just outlined will be possible. So as long as we can see a contract in date, then we can go to many lenders in the market who will simply ignore the accounts altogether. They won't focus on the salary or dividends, and we won't need to worry about any of the numbers within those. What they will look at is making sure that your business account is a fair reflection of the level of income that your contract suggests you earn. Now, if we have to go down the accounts route, though, it is probably a good one to answer, because I think it still helps you to understand how a lender will assess these. And in some cases, if we can secure a more preferential rate with a lender that perhaps isn't contractor friendly, we could use your accounts to do that. So most lenders will look at the last 2 to 3 years worth of trading. There are some lenders that may consider 1 year's worth of accounts, but there are very few and far between, simply because they want to see a business moving forwards and they want to see a progression of that business improving over a couple of years period. If the figures have increased over the 2 to 3 year period, then most lenders will normally average the figures over that 2 to 3 year period as a minimum. However, if the figures have reduced, then most lenders will normally only take the most recent year from the accounts. Now, as well as having a few lenders that will consider 1 year of accounts, there are actually some out there as well that will consider net profit. There used to be some in the market that would actually take operating profit before tax, but those have actually declined. We don't have anybody in the market right now who does that. So there are some lenders that will consider net profit, and again, if the profit, the business is very profitable, if you're doing very well, then you can actually maximise the net profit figure plus your salary on top of that to actually secure a considerable level of borrowing. Now, we were also asked what multiplier is the amount loan typically based on. So is it, say, 3 times salary? Actually, it's far bigger than that. And this year we have seen some reduction around what lenders will consider or what lenders will allow. You can actually get up to as much as 4 to 4.5 times income with some lenders in the market. I should add that isn't typical across the whole market. There are some that will only cap at 4 times. But there are a significant amount that pre-lockdown in March were actually going as far as 5 times income. Now, unfortunately, what we did see is, because of a concern around risk and a concern around potential decline in the market, many lenders, particularly I pull out these two because they are quite high profile. So someone like Barclays actually reduced theirs down from 5 times to 4.49 times borrowing. Still fairly significant though. And NatWest, who reduced theirs particularly for self-employed applicants down to 4.25 to reduce the exposure. So it's important to bear in mind that these figures do fluctuate. I mean, I really wouldn't be surprised, having, again, been in this industry as long as I have, those figures will go up and down in line with risk appetite in the market. So if you're not in a position to proceed right now, don't worry. I'm sure you will see an increase in those in the next 12 months. But if you are looking to move forward right now as well, to be fair, 4.5 times your income, if we can annualize it using your contract, if we can use the figures from your accounts, it will still give you a fairly significant size of loan. Now, Simon also asked, would turnover ever be used for a well-performing company over salary and dividends? And to be fair, the short answer to that is no. I mean, to some degree, the annualization process we use with contracts, it's arguable, does to some degree for a limited company director, in essence, mirror that. But it's not really something you find in the market. So I wouldn't ever expect to be told that that is possible. I was also asked what kind of earning history is used as the basis for lending decisions. So, essentially what kind of level of information is a lender looking for? As I mentioned, 2 to 3 years worth of trading accounts is usually typical. For a contractor though, it can vary. So we have some lenders out there that will work from for literally the first day someone's moved into contracting with the first contract they've received. And in some cases, they may not even need to see payments going into your account. However, flip that, and there are lenders in the market that will go as far as 12 months to 2 years worth of history. So it very much depends on the lender we're dealing with. A decent broker will always look at your situation and consider who's best placed to service your need based on the level of information you've got. But just be prepared that some lenders may ask for more information than others. I would typically say it's a good idea, if you don't do this, to keep your contracts in one place so you've got them for reference if ever required. And also, they do always need to be countersigned by your agent or your end client if they do normally sign a document. So bear that in mind, because you may be asked to supply a signed copy. One of the final questions Simon asked was, do high street lenders typically lend to company directors and self-employed, or is it a specialist lender requirement? And the good news here is, and I think this is really, really important to say, and we've been shouting this for many, many years as a company specialising in this area, we can go to many, many high street lenders in the market who will deal with self-employed contractors and many people in your position. And it doesn't mean that your lending options are segregated from those of the people that work on a PAYE basis. So you can secure products that are as favourable as the product's available to someone that works on a PAYE basis, and you aren't limited with the vast majority of lenders in the market. It's really important to understand that. So don't be worried that you're going to be charged a premium just because of the way you work, because that is not the case. And I've also mentioned, just to highlight, that lenders like Barclays, NatWest are out there that will look at a contractor, particularly self-employed people. There are many, many, many others, lenders you would have heard of, that are in the same boat. Now, I've also received some questions for a gentleman called Mark. So I'll just run through these. So why lenders excluding those that potentially have been on furlough? It's a really, really good question at the moment, particularly in the market we're in and where we are. So, sorry, Matthew, is the sound okay? Matthew Laurie, I just saw you mention the sound had gone. It looks like it's back. Okay, perfect. So I've got why, so why lenders excluding people that are on furlough? Now, it's a really, really important one to bear in mind. I think a lot of this, I mean, to be fair, furlough has really caught a lot of lenders unaware. This certainly wasn't an expectation to have to deal with at the start of the year. And we've seen this process change over the last couple of months. If you think about the fact that a lot of people may have taken mortgage holidays as well, what lenders have had to do is rapidly change the way they assess an application to bear in mind these significant changes. So what we've seen around the furlough side of things is lenders have to some degree, definitely an attitude that it may suggest that there's a risk that someone may become unemployed at some point in the future. Arguably, that is not the case for many people. I would wholeheartedly agree with that. But from a lender's perspective, unfortunately, whether you agree or not, there is a sense of risk there. So what most lenders will look for, just to guide you on this, they'll normally want to see anywhere between at least 1 to 3 months worth of return to work with full confirmation of pay before they would consider lending to you. So if you have been on furlough, I would bear that in mind, because you are going to have to get yourself into a position where you have that level of evidence before you proceed. Now, we also had a question on self-employed applicants, reducing tax via the limited company. How can this be tackled for a mortgage application? As I mentioned already, if we can effectively negate the need to even consider using the accounts and solely look at the contract, the day rate, and your business accounts, if we have to, then we don't necessarily have to worry about the changing face of the way your limited company has been running when accounts are being scrutinised. Now, one other question Mark asked as well was, some lenders regard limited company freelancers being self-employed and therefore, in his experience, may remove the option of interest only. Is there a way to negate this issue? Now, actually, to be fair, I would bear in mind that to some degree, as long as we can get past the income hurdle, as I mentioned previously, then we're actually okay to start then looking at the options of interest only. And many, many lenders in the market do actually offer interest only at the moment. The problem you're always going to face with interest only, for anyone that is particularly interested in this, is repayment strategy is vital, and it's a really, really, really fundamental part of how this process works. If you aren't aware, there's 2 key options in the market on 2 repayment methods. You have a capital repayment mortgage and an interest-only mortgage. Capital repayment is very simple. A lender will simply set your mortgage up on the basis of you paying incremental chunks of capital and interest back as you go through the period of your mortgage with them. So essentially, when you get to the end of the term, you've paid it off. Now, interest only, again, is pretty much what it sounds like. You're only servicing the interest, and at some stage the debt has to be paid off. What lenders used to do with this was consider allowing you to say, look, I'll just sell the property in 20 years, 25 years, whatever the term might be, to clear the debt. But that's become less and less of an option. And actually, what we're finding is the only way lenders will allow you to do that these days is to do that with secondary, third, fourth, fifth properties you may have in a portfolio. They won't often consider the equity you've built up in your property to allow you to do that. And the only way they will do that is if you have a significant amount of equity within the home that you're putting up as collateral. So I would bear in mind, as a benchmark, you're normally being asked to supply at least 25% as a deposit to secure an interest-only mortgage. And most lenders will ask for a considerable level of information around your repayment strategy. So you'll normally be looking at things like supplying savings account information, up-to-date valuations of property that may sit in a portfolio that you're going to use the equity from to support the mortgage. There's many other ways you can put this forward, but you will be asked for a significant level of information to actually proceed. So that's essentially it from the questions I received today. Pre the presentation today. Now, if I could just go back to a couple of the questions I was asked, I think some of these are fairly detailed. So what I may do is just cover off a few of these via email, because it might be easier to answer these for you. Just to cover one here, I can see they're from Olga. Can I get my mortgage through my company and then live in the property? Unfortunately not. You can't do that. You cannot secure a residential property through a company you own to actually then get a residential mortgage on it. It's simply not allowed. And there aren't lenders in the market that will do that. So I'm just going down these to see if there's any other on here. Someone else has asked if there's any plans to extend the stamp duty holiday, as mentioned before, Ash. To answer that one, keep an eye on the market. I would suggest if you keep a good eye on Google News and regularly check up on stamp duty holiday extensions, you'll see some chat around that on there. I think there's a lot of pressure on it. I haven't heard anything right now though, but we're definitely keeping an eye on it. Absolutely.
CMME Mortgages for independent professionals.